what I would say the intrinsic value of Robinhood. Here's the punchline for the whole episode. From flankinvesting.com, this is Money Grooves, the show for intelligent investors. I'm David.
And I'm Elliot.
In today's episode, we'll be determining the intrinsic value of Robinhood. Elliot, do you know what intrinsic value is?
I have not a clue, David.
Intrinsic value is like a super important topic in Buffett-style investing. And instead of me just riffing and waxing poetically on what it is, let's see what Buffett thinks it is.
Oh, but you're so good at waxing poetically, David.
That's true.
Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making investment and laying out money now is to get more money later on, right? That's what investing is all about.
Yeah, so we'll break that down into two components. The first component is being able to predict the future cash flows of the business from now until Judgment Day.
Right, easy, no problem.
Easy, yeah, no problem. And the second part is discounting those future cash flows to the net present value of money.
Sure.
We'll talk about that later. That one's a little bit more, that's a little bit more of an advanced topic.
Okay, great. I'm excited. Let's go.
Let's go. This is actually perfect timing for me because, I've talked about it on the show, but I made a position in Robinhood. I took a position in Robinhood back in April.
Yep.
And, just looking at the price graph for it, it shot. I bought, right, my timing was perfect. It normally isn't the opposite of this. But from when I bought to now, it's gone up, something like 200%. It's up 450% in the last year.
Crushed it.
So my question is, should I sell? Is this thing fully valued? Right.
Great question.
Sometimes that's a harder question to answer is when do you sell?
And typically for us as long-term investors, we are not always looking to sell. Selling is not necessarily the first thing we're looking to do.
Yeah, no. Our favorite holding period is forever.
Right.
But when I see a stock completely go over its skis, I'm thinking I'm kind of getting a little sweaty. Like I want to take my winnings if it's time.
Sure.
But the best way to do that, really the only way to do that, is to know the value of what you actually own.
Okay.
And the way you determine what you own is you learn what you figure out what the intrinsic value is.
Okay, this sounds great. Walk us through your process.
Yeah, so to determine intrinsic value, just like Buffett said, you're going to have to figure out what are the future cash flows of the business.
Sure.
It's best to just think of a business like a cash printing machine.
Right.
Will that cash printer make more money in the future, less money in the future, or the same amount of money in the future?
So what are some things I can look at to determine that? How do I make that determination?
Yeah, so we'll keep this one simple. In the Flang methodology, we walk you through 3 different valuation approaches. We do discount cash flow analysis, a 10 cap valuation, and discount earnings analysis.
Okay.
So we'll just to keep it simple, we'll just focus on discount cash flow analysis. It's the most common one you'll see on Wall Street, and it's what everyone loves to talk about, DCFs.
Right.
So to do a DCF, and if there's any questions, we'll plug this again later in the show, but we walk through exactly how to do this on our course that's on the site. So with tons of Buffett references, but we'll give a quick primer on how to do it.
Nice.
So we need to figure out the future cash flows of the business.
Oh, a spreadsheet?
A spreadsheet.
Wow.
Of course, we knew a
What a
spreadsheet
good
was
day.
coming. And I've included that you can find the link if you're doing your own DCF. You can use this spreadsheet. I made it available for anyone. But you're going to look at the current free cash flow of the business. So for Robinhood, we know that their current free cash flow, it's up 833% in the last year, which is wild. To $4.5 billion.
Yeah.
So then, and then you take your expected growth rate. This is the tricky one because, well, how do you know?
Right. How do you know?
Yeah. How do you know how much it's going to grow? And I can answer that. The way you know how much it's going to grow is from your earlier steps in your analysis. Like I had, my first step, which I completed this research step a long time ago, but I did this 6 months ago. What does their historic growth rates look like? And I just pulled screenshots from the Flank platform for this. So you can see that like free cash flow has kind of been all over the place, which is not something Buffett likes to see. He likes to see steady growth.
Right.
But it's a relatively young company.
Right. I was just thinking that. Like, it's a relatively young company. It's a tech company. They're getting established in their domain. Yeah.
But then more importantly, and this is actually my favorite step in analysis, is what is their growth strategy? That's our third step in the methodology. And so we walk through, I walked through exactly what Vlad laid out their growth strategy was 6 months ago, and it really hasn't changed too much. They said they want to win in the active trader market. They want to increase wallet share. They want to expand internationally. That's straight from their annual report.
Nice. Oh, annual report. There we go. We're checking the boxes for this episode.
Yeah, and then in other interviews and discussions, they're trying to open up 24-hour trading market. They recently announced a social site. The one that I'm really excited for is event predictions. Right, my whole thesis, which you can find on Flank and we've talked about on this show, but my whole thesis is that they've built up a genuine investing brokerage, custodian, RIA, whatever.
Yep.
But they've also attached a casino next to it, and we all know casinos make a lot of money.
Right.
So
favors the house.
Yeah, exactly. Yeah, and the house always wins.
That's right.
And we also broke up. The first step in the whole Flink methodology is how do they make money, and we showed in this one that the number one way that they make money is through options, selling options contracts to individual investors. Yep. And then cryptocurrency is their number two. Yeah. So, and those things are just on fire right now.
Yeah.
So, getting back to all that, that's where DCF people, a lot of times people want to say, all right, I can just build a model without understanding the business. You can't. You need to understand the business, because how do you know what that expected growth rate is? You can look at analyst expectations, but that's not. What then do you know that Wall Street doesn't? It's not a bad idea to check those analyst recommendation or analyst predictions, but at the end of the day, it's us as the investor that needs to be responsible for that number.
And by using Flank, you're doing your own analysis, right? You're looking at the same information that analysts on Wall Street are looking at, and while you may not have some of the knowledge they have, you're still doing your own research. You're still making your own opinions about the business and using industry standard information to do that.
Yeah, absolutely. So then the next step, after you determine your growth rate, which I assumed a 15% growth rate in this model, and then you take the historic price to free cash flow, which this number you just got to get off of the internet. We have historic means we're summing up everything. On Flank, we give you the price to free cash flow. So for the last year, it's been 18.76. We don't have a longer term historic data on that, but and you can just find I found it with a Google search, but it's been about 17.82. So then I'm not going to go through the math. If you want to learn the math on how to do DCF analysis, take the course. It's boring, but it's important.
Don't say that about math, David. Math is important.
Yeah. But then what this is doing is it's taking that growth rate and it's taking that free cash flow and it's saying, all right, in year 2, if it's growing at 15%, then it'll have $4.5 billion in free cash flow. And then it'll have 6.84, and just using that standard growth rate, right? And then at the end you give a terminal value where you multiply that last year of free cash flow and then times the historic price to free cash flow. So then you're getting at what the price would be.
Sure.
So that's the first step. That's Buffett saying that if you were to predict the future cash flow from now till Judgment Day.
Right.
The second part, and this part took me a long time to understand when I was learning investing, but the second part is you got to discount it to present day.
Sure.
Do you have any idea what that would why you have to discount what discounting is?
I feel that it probably pertains to the fact that if you look at something now and the same numbers are going to mean something very different in the distant future, it basically seems like inflation, accounting for inflation.
Yeah. So it does have to do with it being into the future. The three main reasons, there's this concept called the net present value of money, or time value of money is what this Wikipedia article shows. But that's saying that the time value of money refers to the fact that there is normally a greater benefit to receiving a sum of money now than an identical sum later. That just basically means $1 today is better than $1 tomorrow.
Sure.
Because you have opportunity costs, you have it's less risk, and for a whole bunch of reasons. Funny enough, and I can't help myself, I'm diverging off the script a little bit, but I have to because I just love this. In most interviews with Buffett, when he actually people start talking, because people ask him all the time, how do you value businesses?
Right.
He always goes, well, the first person to ever value a business was Aesop, 2,000 years ago, when he said 1 in the hand is better than 2 in the bush. And it's like, well, what the heck does that mean? 1 in the hand is better than 2 in the bush. And then he colors it in by saying, Well, the question is, how far is that bush? What is the cash flow of that bush? What are interest rates?
Right.
And so like it basically, it's a beautifully robust way of saying that, yeah, we know that $1 today is better than $1 tomorrow. We have to impact that. We have to know what the growth rates are and all that. But because of the time value of money, because of opportunity costs, you have to discount it back to present day.
Sure.
All of that to say, there's a lot of debate on Wall Street on what discount rate do you use, and I'll nerd out all day with a finance bro on that.
Sure.
But I like to choose just what long-term interest rates are.
Okay.
That's what Buffett says, and you just need to pick something. So that's what I recommend. So I just did 5% as my discount rate. So then in this model, what Excel is doing is it's just taking all of these, it's taking these cash flows, discounting them back at 5%, and then I get my discounted terminal value. And then the sum of all future discounted cash flows is $275.94 billion. So that's saying what the market cap of the company would be.
Sure.
So based off of this analysis, right now Robinhood has a $110 billion market cap.
Your model predicts it'll have a $275 billion market cap.
Is what its intrinsic value is. Yeah.
Okay.
But it doesn't end there. Just when you thought we were almost done, there's one last thing. And there's a beautiful Charlie Munger quote that I have to pull up because it uses a word that I didn't know before this, vicissitudes.
Oh, yeah.
Do you know what vicissitudes are?
Absolutely not.
Yeah,
This is not a good episode for me.
No, it's great. It's learning. I mean, this is such a random thing.
It is learning.
So Charlie Munger has a really famous quote where he says, "No matter how wonderful a business is, it's not worth an infinite price. We have to have a price that makes sense and gives a margin of safety considering the normal vicissitudes of life."
Nice.
It's like, what the hell is a vicissitude?
Wow.
We do first sources here.
First-hand sources
Yeah.
here.
A change in circumstances or fortune, typically one that is unwelcome or unpleasant.
Oh, nice. Okay.
So it's basically just saying shit happens. So you give yourself a little bit of a buffer, and you
right.
can choose any margin of safety you want. If you're just getting started, you could do a margin of safety of 70%.
Sure.
I like to do 30%.
Okay.
So what I would say the intrinsic value of Robinhood, here's the punchline for the whole episode.
Okay.
With margin of safety, $192 billion is what I
okay.
think the intrinsic value of Robinhood is.
Okay.
Or do I?
Oh, okay.
Because there are two other valuation techniques.
There's always
a
more.
10 cap.
There's always more.
And there's a discount earnings analysis. And we're not going to cover those because we got to keep this show tight and we'll get really boring. But if you do want to learn more about this, you can check it out, flankinvesting.com/learn. We have a whole course, and majority of it's free. And at most it's $20 a month to get to the latter half of it. But that'll show you exactly how to do all these steps that I just talked about. And we have the data platform of Flank to make it even easier for you.
Nice, awesome. I can't wait to do this in my own research when I start digging into Garmin.
I'm very excited for you to do your first DCF. That's like it's like reading your first annual report. It's like a rite of passage.
A
as
rite
an
of
investor.
passage.
Yeah.
I'll text you when I do.
Yeah,
You can
I'll
give
see
me
it on
a
Flank,
high
right?
five. Oh yeah, you will see it on Flank. Oh wait, I have to unblock you.
That's all for this episode. Thank you so much for watching. Again, you can learn more about this whole process if it's confusing on flankinvesting.com/learn. Hope to see you over there, and we'll see you in the next one.
Thanks, everybody.